Now, bonds. This is what a bond certificate looks like. We talked about bonds, and we said that this is usually a form of financing. This is when the company needs to raise a lot of money. At that point, it becomes very difficult to get that money from one entity. For example, using a loan, like a notes payable. So they would issue bonds. This is to finance big projects, okay? And when the company does that, they would, before they actually are allowed to do that, they have to get the approval of the board of directors as well as the shareholders, because this is a major event. This is basically where the company is borrowing a lot of money. The board of directors will decide on the number of bonds that are authorized to issue, which is not always the same number that is actually issued. Usually companies, for example, if they are authorized to issue, say, 1 million bonds, they would instead, they don't issue the whole million bonds. What they issue is, for example, I don't know, 70%, 80% of them, something like that. So they issue a part of it, and then they keep the remaining part for a rainy day. If they needed additional funding in the future, they would do that. The board of directors decides also on the face value, that's the amount that is shown here. For example, this is here, the face value in this one is 5,000. In general, most bonds, they will have a face value of 1,000. Okay? So that's the actual value of the bond. That's not the market value. Remember, bonds will be traded in the market. That's too hard, right? Anyways, so on the bond certificate, you might find, if it's registered to a certain name, you find the name on the certificate, like this one. You'll also find the maturity date and the contractual or stated rate. So this is the contractual interest rate. That means it will yield 16.875%. Okay? Any questions? This one, it will also mention the maturity date. In this case, it's May 2019. May 1st, 2019. This is when the actual amount will have to be paid. Generally speaking, interest is paid semi-annually. It means every 6 months. That's how it usually happens in practice. So, for example, now you have to understand something. Bonds are traded actively in exchange markets. So, in a way similar to stocks. So bonds are, you have municipal bonds, you have corporate bonds. Those are traded actively, and as a result, as any other commodity, the price might change. Okay? So it's not always sold at the same value that shows on the certificate itself. The certificate, the face value is, say, $1,000, but the market value might be different. There are different factors that affect that value. So, for example, the way it says here, this is outstanding 5.125%. You have $1,000 bonds, that's the face value of the bond. You have, they matured in 2014. Okay? You have the yield, and then you have, on this day, this is the volume of traded. This is the volume of bonds that were traded on that day. Now, when you hear here, for example, when you see that they were sold, the closing price was 96.595, that's 96.595%. This means this is 96.595% of the face value. So the face value is 1,000. Multiply that by how much it was sold for. So this is, let's say if it is 97%, that would be $970. So the actual trading price was not $1,000 for the bond. It was 970. It could go, for example, it would be like 965.95. It could be sometimes higher. So instead of that, they will tell you it's at 103. When you hear 103, it means 103%. So that would be at $1,030. This is how much it was sold for. Any questions about this? Okay. Now, what affects the value, the market value of a bond are different things. First of all, there's the length of time until when will it be mature. So let me put it this way. If I tell you that you give me a loan today of $100,000, and in 10 years, I'll give you back the $100,000. Okay. So if I tell you now that I will borrow, I would like to borrow from you $100,000 now, and in 10 years I'll give you exactly $100,000. Would you invest in my company? Would you lend me the money? If any one of you agrees to lend this money this way, please come see me after class. I would like to do business with you. But generally speaking, you don't do that. Why? Because you want to make money. You're investing money, or you're lending money, or you're using your money to make profit. So if you are going to lend a company some money by buying their bonds, you want to have interest. This is why bonds, it's a loan, it's not an investment. So this is, you're lending the company money and you're receiving that interest in return. Okay? In addition to the full amount that will be paid back at the end, at maturity. So what affects a certain bond, the price or the market value of a certain bond, is that, for example, how long it will take until maturity. So basically, if you are going to lend a company for 20 years, and it's not until 20 years later that you will get the money, that you will get your money back. That's different from a 5-year bond, right? 5-year bond, you will say, okay, I will get back my money in 5 years. In 20 years, God knows what happens. A lot of things can happen. So this is why, usually, the length until maturity, it affects the price and the value of that bond. There's, of course, the interest that you will receive from that bond. So if it is 5%, that's not the same as 15%. Plus, there's also the market rate of interest. So the market rate of interest, this is basically what other lenders in the market are asking for. In other words, other similar bonds in the market right now, how much are they getting on average? So this is the market interest rate. Okay? So if the rate of interest of your bond is lower, would be people willing to lend you money? If the return of their lending money, of their purchasing your bonds, will give you them 5%, whereas in the market it's 8%, will people buy it? They won't. Okay? However, sometimes they do buy it. So what do you need to do for that? The price will have to go down. So basically, if you tell someone, okay, I will give you 5% while the market rate is 8%. However, instead of selling my bond to you at $1,000, I'll sell it to you at $950. Now you have, in addition to the interest of 5%, you have this extra $50. Do you understand now what we need here? It's less desirable, so you will have to discount, to provide them with a discount. So you will be selling, the company will be selling their bond at a discount. Okay? To make it as appealing as the market. Now, in certain cases, if your bond, remember, the status or the contractual interest rate will be decided by the board of directors when they approve of issuing the bonds. But between the time the board decides and approves of that, and then and the time where the company actually issues the bonds, there are a certain period of time. Okay? During that time, the market interest rate will change. It is very rare that they would be the same. But generally speaking, they would be different from the day it was approved. So between the day it was approved and the day it was actually issued, the market interest rate would be different. This is why the company, if the company's bond has a market rate of 10%, has an interest rate 10%. The market's interest rate is 8%. Which one is more appealing? Sorry? The 10%, which is the company. So the company's bonds are very appealing, right? They can take advantage of the situation and they will say, okay, our bonds are more appealing than the market. You want it? You have to pay extra for it. So instead of selling you that one for $1,000, you will have to give me 105%, $1,050, and then I will give it to you at this interest. At maturity, let's say 5 years later or 10 years later, the amount that you will get that the company will be paying back will be 1,000. Remember, bonds payable will be at face value. So it's not going to be at a higher amount. So let's see now how this happens. Okay? Oh, one more thing. The companies, when they will actually record, they make a journal entry when they sell bonds, when they buy them back, or when they are converted to stocks. Remember, we said that there are convertible bonds that can be converted into common stock. Those are the three cases when the company actually makes an entry. When the bond owners sell it to another bond owner on the market, the company is not concerned. The company does not care who owns the bonds. They only care about that because they need to know where to send interest. But they don't make any journal entry. As far as they are concerned, it could be it could be, for example, bond owner 101, bond owner 102, 103, etc. So it's like a username, nothing more than that. They don't really care who the actual owner of that account is. Think about it as accounts. They don't really care who the account owner is. All they care is to record is when they sell new bonds, when they buy them back or redeem those bonds, or when the bonds are converted into common stock. So for example, this is when the company will sell their bonds at face value. When we say at face value, this is at $1,000. Okay? This happens when do you think that this would happen? When the bonds rate, when the market interest rate is equal to the contractual interest rate, which is also called a contractual interest rate or savings interest rate. In this case, which one? It's when they are equal. When they are equal, the company's bond is as appealing as the market. So it will be sold at face value. On the other hand, when the company's interest rate is higher, like in this case, this one is higher. It's higher than the market interest rate. It's more appealing, right? It will generate more interest to the people who will buy it. So the company can sell it at a premium. Second one will be at face value. The last one is when the company's bond, the contractual interest rate is less. This one here, it's less than the market interest rate. In this case, it will be sold at a discount. So let's see how the companies would account for that. On January 1st, 2015, Candlestick Inc. issues 100,000 5-year 10% bonds at 100. So this is 100% of face value. How do you make the journal entry? What do you write? So what does the company do? When they issue bonds, what happens?
Cash.
They get cash. How much? 100,000. Cash will always be the amount that the company will be selling them at. The company is selling them at 100. So cash is 100 multiplied by, it's 100% multiplied by face value. In this case, they issued $100,000. So cash will be $100,000. Bonds payable will be credited $100,000. Bonds payable will always be at face value, or par value. So the company will always record bonds payable at face value. Okay? Now, on January 1st, the company issues those ones. This is the one. This is the same one. Now, assume that interest is payable semi-annually on January 1st and July 1st. On January 1st, what's the journal entry? The company will pay interest. Interest is always the contractual interest rate multiplied by face value. Always. Okay? Now, this is for the year. If it's paid semi-annually, that means it's multiplied by 6/12, right? So this would be 100,000 multiplied by 10% multiplied by 6/12. That's how much? That's $5,000. This is what? To the company, this is what? The company is paying for what? Interest. So this is interest expense. So the company will debit interest expense, will credit cash. 5,000. Okay? Now the next payment will be, this is on July 1st because the company, they signed it on January 1st. When is the next journal entry? That's the next payment. But when does the company have to recognize interest? End of the year. So on December 31st, the company will still have to recognize interest that has accrued, but not paid, but is not paid yet. So this is still the same amount, 5,000. Interest expense will be debited, right? What do we credit? Is the company going to pay it on December 31st or January 1st? January 1st. So on December 31st, the company will not make the payment, but they recognize the interest expense. So what do we credit? Interest, we debit interest expense, we credit interest payable. Thank you. On January 1st, when the company actually pay, the company will be paying their debt. So on next January 1st, the company will be paying interest payable, 5,000, and we would credit cash. So we would debit interest payable, we credit cash. Any questions about that? This is when the bonds were issued or sold at face value. Okay? Now we also have issuing bonds at discount. As we said, this is when the company's product is inferior in a way to the market. How do you translate that in bonds terms? If the contractual interest rate is lower than the market interest rate. So it's less appealing. Think about it as an inferior product. What do you do when you have an inferior product? You discount it. So the company, what the company will do, they will sell it at a price that is less than 100% of its face value. In this example, the company is selling the same bond, however, here they are selling it at 92.639. So how much cash will the company receive? 92,639. This is the amount of cash that will be debited. That's how much the company will receive in cash. What about bonds payable? Still at face value. Bonds payable will always be at face value, which is 100,000. What about the difference between the two? It will be reported as discount on bonds payable. That's a contra account. So the company will debit discounts on bonds payable and credit bonds payable 100,000. Okay? So in this case, this is a contra account that will be deducted or subtracted later on from bonds payable. So it will be bonds payable less discount on bonds payable. That will be the amount. Any questions? So this is how it will look like. Now, this is what we call the carrying value or the book value. So this is when you hear carrying value or book value of the bond. It's basically bonds payable less the discount. Okay? That's the. So in this case, what happens to the cost of borrowing? So the cost of borrowing is how much it costs the company to borrow those $100,000. All right.
In this case,
It's an additional cost, right? It increases the cost of borrowing money. So instead of paying just the interest, now you're paying the interest, and there's also you're losing the discount. That's why it adds to the cost of borrowing. Now this is one way. Those are two different ways of calculating the cost of borrowing. How do you calculate the cost of borrowing? The first method is where you have this annual, the semi-annual payments. This is here. You're calculating interest, and you add to that the discount. The cost, if it were at face value, the company will get $100,000 when they issue the bonds, and when they will be paying those, because it's 5 years, right? So the payment is semi-annual. It's 5,000. That will make it 50,000 in interest. So the cost of borrowing would be 50,000, because 5 years later the company will have to return the 100,000. So they got 100,000. Okay. They had the cost was 50,000, and then they have to pay. This is the amount that they will have to pay. Okay. The cost was 50,000. If you want to see, so this is for face value. That's for face value. When it is sold at a discount, what happens? So the first one is when you add the discount to the face value, to the interest. I'm sorry. That will give you, this is the cost. Another way of thinking about it is this. The company received 100. So this is the amount that the company will have to pay back. The company will also have to pay back the interest. Those are the amounts that the company has to pay back. Okay? How much did the company actually receive? It was 92,639. So if you want to think about it like this, it will be the company received 92,639. They will have to pay back 50,000 interest, and they will have to pay back 100,000 as principal. Okay? So that would be, the company will have to pay 57,361. That's the cost of borrowing money by issuing $100,000 of bonds. Any questions about this? Okay, let's do this one. You need this question? Oh yeah. It's very simple, it's straightforward. Or if you're reading this material. 87%. So, that doesn't make it better, but okay, I'll give you that. So I'll give you a smiley face. Good? So I will give you a smiley face. Let's do the next one. That's actually very close to the class average of the exam. So you would deserve a frown. Oh yes, Peter. So, okay. That's in between. So, it is actually contra account. Now, that was issuing bonds at discount. That was when the contractual interest rate was lower than the market. Now we're going to look at it when it is higher than the market. So this is 10%. Okay, the company was able to sell it for 108.11%. Company issued the bonds at 108.11%. 111%. Okay. What's the journal entry here? Right.
Cash is 108,000.
That's correct. So cash will be debited 108,000 and $108,111. Then how much? What else? What do you credit? Bonds payable 100,000. So you will credit bonds payable 100,000. The difference between the two will be credited to premium on bonds payable. Okay? So this one will be added, for the carrying value, this one will be added to bonds payable. Okay? Now, premium on bonds payable is an adjunct account. Don't need to know more about that at this point. So let's keep it at this. It simply is added to that liability. Okay? So what happened here is it will have a normal credit balance, unlike discount on bonds payable, which has a normal debit balance. So that one is a contra account. Any questions? So when you have a a discount on bonds payable, you will be debiting cash, right? You debit also the discount, you credit bonds payable. When the company is issuing bonds at premium, you debit cash, you credit both bonds payable and premium on bonds payable. Any questions? As you can see here, that's the carrying value. And you have here bonds payable, add premium on bonds payable. Any questions? Now, what does premium on bonds payable do to the cost of borrowing? Decreases it. I mean, if discount on bonds payable increase the cost of borrowing, the premium would decrease it. So let's do it in the same way here. In this case, you subtract premium. So that's the premium. It's subtracted from the interest that is paid. Basically what we're saying is that the company received 108,000. They will have 111, okay? They will have to pay back 50,000 in interest, and at maturity they have to pay the face value, 100,000. What's the cost here? It's 41,889. It's less than that of the face value. It's less than the cost of borrowing at face value. Do you understand now the difference between the two? Any questions? Are you sleeping or you're actually getting the information, you understand the material? You're not sleeping. You promise. Okay, good. You're speaking to me, but not everyone is speaking to us. Okay, no one is speaking. Good. Okay, so the company, they issued 10-year bonds with a maturity sale of 200,000. Well, with a maturity value of 200,000. If the bonds are issued at premium, this indicates that usually it has to be more appealing to be sold at premium. It means that the contractual interest rate is higher than the market interest rate. Now we get to redeeming bonds at maturity. Redeeming bonds. What do we mean by redeeming bonds? This is when the company actually takes back the bond payable, and then what they do is they pay it back. So when it is at maturity, like the previous example, it was 5 years later, company will pay how much? At maturity, the company will have to pay how much? Face value. The company will be paying face value. So the company will be paying in cash. What happens to cash? Decreases, right? So what do? We credit cash. What about bonds payable? What happens to bonds payable? They decrease, so they are debited. We debit. We will debit bonds payable, credit, cash. This is when it is redeemed at maturity. This is it. And this is not considering, basically this is considering that all interests were paid before. So in this case, we're talking about the actual bond payable that is being paid back on the day it matures. Now in certain cases, companies, you remember we said like there are callable bonds and stuff like that. You can have also when the company, this is when the company wants to decrease their debts. If they have enough cash to pay those ones, they might redeem it before it reaches maturity date. So instead of waiting until it reaches maturity date, they want to redeem it in advance. So what do they need to do? First of all, they need to make sure that all interest is paid until that moment. Okay? They need to make sure. What they do is they need to record the cash that was received. This is for how much they sold it. This does not have to be the same, this does not have to be face value. Remember that in this case they are buying it based on the market price. So if they buy it at 103 or if they buy it at 97%, it's different. So you have to record the cash that's received, the cash that's paid, I'm sorry, not received. The company is paying this cash. So this is the amount of cash that the company is paying. You also have to eliminate the carrying value. Okay? You eliminate carrying value, and you have to recognize loss on redemption or gain on redemption. This depends on how much you actually sold it. So it will depend on how much you sold, you bought it back. Now, one thing that will have a difference is if you still have any unamortized premium or unamortized discount. This will affect what? The carrying value. Because the carrying value is the face value less any unamortized discount or plus any unamortized bonds, yes, bond payment. You mentioned, I'm sorry. Let's see how this is done. You will understand it hopefully better with an example. Assume Candlestick Inc. has sold its bonds at a premium. So when the company originally sold or issued their bonds, they sold them at a premium, which is to mean they sold them at more than face value, right? At the end of the 8th period, Candlestick retires these bonds at 103 after paying the semi-annual interest. So interest is paid. Now they want to redeem them. The carrying value of the bonds at the redemption date is 101,623. This is the carrying value. So what's the premium here? Sorry? Yes, the premium in this case will be, so the premium is equal to 101,623 minus face value. Just to mean it's 1,623. when the company is redeeming the bonds, they retire their bonds at 103. So how much did the company actually pay in cash? Is it 100,000? Is it 103? Is it 101,623? Thanks, Imran. It's 103. Okay? So it's 103,000. This is how much the company retired those bonds at. So they retired it at 103. This is the amount of cash that the company paid. This is the amount of cash that the company will credit to cash. Okay? So cash will be credited 103,000. Bonds payable will be debited how much? Always face value. So bonds payable will be debited 100,000. Okay? We have premium on bonds payable will be debited because we still have premium that was credited. See, this is like a reversal of the purchase. Okay, not the purchase. This is the reversal of when the company issued those stocks or sold those bonds. Okay? So when the company sold those bonds, what happened? Remember, the company debited cash, credited, bonds payable, and premium, right? Premium on bonds payable. Now we'll do the opposite. We will debit bonds payable and premium on bonds payable. We will credit cash, and any difference between the two will be recorded either as a loss or as a gain. Now when you have a premium, and in this case, what's the difference? This is the amount of cash that the company had to pay. What was the carrying value? The difference between the proceeds, the difference between the payment and between the carrying value will be, in this case, it is positive. So the company paid more than the carrying value, so they will record a loss. If the company had received more, it would have been what? Again, think about it this way. The company paid less than its carrying value. It would be more. This is in a way similar to, if you remember, when we did disposal of plant assets. It was on the exam. Yes?
But if it was a gain, would you put it on the other side?
Yes. Remember, total debits must always equal total credits for every transaction. So for every journal entry, you have debits equal to credits. So let's say here that the company, instead of redeeming them at 103, let's say that instead it was 101,000. Okay, if it were 101,000, what would you do? You would have here a gain. The company paid less than its carrying value. So 4,000 bonds with face value of $1,000 each are sold at 103. The entry to record the issuance this is when the company issued the stocks. It's not when the company retired the bonds. I'm sorry, I keep saying stocks. So it's when the company issued those bonds, not when they retired those bonds. Okay, so the correct answer is A, and I will give you a smiley face just to encourage you. Where's the what? What? Oh, you did not? 37%. Okay? Now, you have to understand something. When the company, okay, that's okay. So when the company issues bonds, if they sell it at 100, that's face value. If they sell it at less than 100, So if the company sells it at less than 100, the company is actually issuing those bonds at discount. Okay? If it is more than 100, will be what? At premium. Okay. So when the company sells, first you need to look at this one here. Okay, so when the company issues bonds at 103, like here we have 103, it's higher than 100%. So the company sold it at premium, which would automatically remove answers B and C. I'm sorry, B and D. The ones that could be correct are A and C. Okay? Cash will always be the amount that the company will receive from selling those bonds. So it's 4,000 bonds multiplied by $1,000, which is the face value, multiplied by 103%. Okay? In this case, anyways, answer C, it does not. So debits and credits, they do not match. This is also has to be basically a clear indication that this is not the correct answer. Now for this question, or questions like this, first you need to try to actually write the journal entry. I personally find it the more or less like the way that would be the most certain way of getting the answer correctly. Because here this is not a complete, it's not a complete journal entry what they are asking you. So it will include, the entry to record the redemption will include. In order to make sure that you got it right, write the journal entry itself. You have here, the company is retiring $800,000 face value bonds at 105. When they retire them at 105, that's the amount that the company is paying, right? The carrying value of the bonds at redemption is $829,960. That's a typical question that you might see on the final exam. Okay. See? So for this question, again, what you need to do is to write the journal entry. When the company is redeeming, when the company retires bonds before maturity, right? This is what's happening. So it's before maturity. You have 800,000, that's the face value, at 105. How much is the company going to pay in cash? So what we need to do is we need to know that we're going to credit cash, how much? 840,000. That's 105 multiplied by 800. This is the amount that will be credited to cash. Bonds payable, always the same thing. Bonds payable will be debited how much? $800,000. Bonds payable, always at face value. Face value, which is 800,000. So the difference between the face value and the carrying value, if the face value is, if the difference between carrying value and face value is positive, and that if carrying value minus face value is positive, that's a premium. That's a premium, okay? So here we have the carrying value is 829,960. So what's the premium here? Premium is? Thank you, 29,960. That's a premium. Okay? So in this case, what's the journal entry? The journal entry would be to debit bonds payable, 100,000. Okay? What else? debit premium, right? Sorry? Oh, 800, sorry. Debit premium on bonds payable, 29,960. So that's what? That's the carrying value. We know that cash will be credited 840,000. The difference between the two will be company paid more than the carrying value. So this will be loss on bond redemption. It will be the difference of those two amounts, 10,040. Any questions? Guys, did you get that point, or are you confused? No.
I guess I'm confused about like premiums. Like why? Okay, I thought like the 829 that's the carrying value. I thought that was a little bit
No. That's not interest. That's premium. This is, you see, what the company originally sold when they issued. Automatically, when they tell you that the carrying value at the bond at the day of redemption was 829,960. That's higher than face value, which is to mean that when the company sold those or issued those bonds, they issued them at a price higher than the face value. When they issue at a price higher than the face value, what does that mean? They issued them at premium. So it was originally a premium. The company had issued them at a higher amount. Now when they are buying them back, they are buying them back at a cost that is higher than face value. In this case, you still need to look at the amount that the company paid and the amount that is the carrying value of that bonds, of those bonds. Okay? When bond owners decide to take advantage of converting bonds to stocks, the company will have to make a journal entry. There will be, you have to understand, there will be no gain or loss. The company will not record gain or loss. The company will stop paying interest when it is converted. They will keep paying interest until those bonds are converted to stocks. When they actually do that, the company will ignore, when the bond payable are converted, the company will ignore market value. Why is that? They are converting a debt. What's the value of the debt? What's the amount of the debt? 800,000. For example, in the previous example, it was 800,000. That's the value of the debt. Anything else is like interest, premium, etc. That's the value of the debt itself. So when they are going to actually debit that liability account to basically convert it to common stock, the company will debit bonds payable face value. Okay? So in this case, let's see what happens. However, the company will still have to, so we'll see in a second how this is calculated. Sounded Associates converts $100,000 bonds sold at face value into 2,000 shares of $10 par value common stock. So the 100,000 will be converted to 2,000 shares of $10 par value. What's the value of those common stocks? 20,000. What's the value of the bonds payable? 100,000. Where did the 80,000 go? They will be added to an account that is called paid-in capital in excess of par value. Okay? This is basically the company will debit bonds payable, will credit common stock, the 20,000, and then will credit paid-in capital in excess of par value. Okay? You will learn later on when we study stocks. Par value is the amount that is originally stated when they issue stocks, However, it is rarely the same value as the stock market price now. Anything in difference, that when they pay that in difference, it will be added to this account, paid in capital. Okay? So that's the correct answer. You have here, what we have here is, the company converted 600,000 bonds sold at face value. Okay? It's 10,000 shares of common stock, par value $1. So the company will debit bonds payable 600,000. Okay? The company will also credit what? Yes. Common stock, how much? $10,000. The difference between the two is paid in capital. In excess of par value. Okay? In excess. Par will be the difference, will be 590,000. Okay? Okay, so at least we agree on the 2,200. That's good. Actually, it is gain. Think about it this way. The company basically, okay, so the company is paying, when the company retires those bonds, they are paying a certain amount. So the company is paying, they are redeeming. You see, they are paying. Company is paying 101%. So how much the company would be paying in cash? 505,000, right? So we will credit cash 505,000. The company will debit bonds payable, how much? Bonds payable will be debited 500,000, always at face value. We have a premium, unamortized premium. What do? We also debit it. So we debit premium on bonds payable. The unamortized amount is 7,200. What's the carrying value? What's the value of those bonds to the company? 500, $7,200. That's the carrying value. The carrying value simply means this is the value according to the company's books. This is how much the company values those bonds. How much did the company actually pay? The company paid 505, so they paid less than the value according to their books. So the difference will be gain, okay, on redemption, which is for the difference of 2,200. Do you understand why it's a gain and not a loss? This is what the company is actually paying. The company is actually paying less than the carrying value. So basically, the company made a gain of 2,200. If the company paid more, so instead of 101, it was 102, it would have been 510,000. That would have been a loss, because the company is paying more than its value according to their books. Any questions? Okay, and that concludes the part about bonds payable. Now, notes payable, long-term notes payable, think about them always as the easiest way to understand them is when you think about them as mortgage. Most of the time, companies, when they issue long-term notes payable, usually they are secured by a mortgage, an asset that would be pledged against that loan. In general, there will be a payment. It's like that when you buy a house. If you buy a house, the mortgage company would actually whenever you make a payment, the payment will be made up of two parts. The first part will be the interest on the unpaid amount, and then you have, in addition to that, a reduction on the loan. So they're not going to wait until Like for example, if you buy a house, they're not going to wait for 30 years until they get all their money. They start actually taking the money from the first month. The amount paid will be in parts interest, in part principal. Okay? When they first recorded at the beginning, it will be notes payable 500,000. For example, notes payable 100,000. So that's the amount at face value originally. So in this example here, Porter Technology issues a 500,000 12% 20-year mortgage note on December 31st. The terms provide for semi-annual installment payments of $33,231. That's semi-annually. Every 6 months, the company will make this payment. Okay? Now, this payment is made up of two parts. Principal plus interest. Those amount of principal versus interest will change with time. Originally, you start with very high interest and very little principal. With time, you'll start paying more principal and less interest. How do you calculate that? The original amount, this is when it was signed. So this is at signature. This is when the note payable was signed. How do you calculate interest expense? You multiply 500,000 face value multiplied by the interest rate, which is 12%. How many months do we have for each payment? Semi-annual. So what does it mean? Multiplied by 6/12. So what's the interest? The interest will be 30,000, right? The installment is 33,231. Interest expense is 30,000. The difference between the two will be equal to the reduction of principal. Now, the new principal will be 500 minus the reduction in principal. That's your new principal. You actually multiply that amount by interest. By the interest rate, this will give you the new interest expense. Again, you subtract it from 33,231, it will give you 3,425. As you can see, the amount paid against the principal starts increasing. The interest expense starts decreasing with time. The monthly installment will always be the same. Actually, if you're using Excel, that will be very, very, very fast. They're very easy to prepare. Just do that and you copy the formulas, basically. Any questions? If you're interested, I can show you how to do that in Excel. So the journal entries. Wait, we're not done. I still have 2 minutes. What's wrong with you guys? 2 minutes. Do you want to take 2 minutes from you from the exam? Don't take them from me in the lecture. Fair is fair. Porter Technology issues, this is the same thing. How do you prepare the mortgage, the journal entries? To record mortgage and the first payment. Mortgage, when it was signed, the company will do what? They received cash, face value, and they will debit cash, 500,000 credit. Notes payable, 500,000. Okay? When they make the first payment, end of June, the company will debit interest expense. They will debit loans payable and notes payable. In this case, because it's mortgage, so they will debit mortgage payable. They will also debit interest expense. Those are the two amounts, as you can see from this table here. Okay, the 30,000 and the 3,231. The company will, in this case, the company will debit interest expense 30,000, debit mortgage payable 3,231. So they will credit cash the monthly or the semi-annually installments. Next time that they will actually make the second payment, it will be the second amount. It will be in the second amount in the table here. So it will be the journal entries will be 29,806, 3,425. Anyways, have a good weekend, everyone.